I'm Julie Brunner, your instructor. In the first module, I covered resale restricted housing and introduced how resale formulas preserve affordability of the home over time. This enables programs to serve multiple generations of home buyers who wouldn't otherwise be able to afford a home. In the second module, Affordable Pricing, I'll explain the concept of affordable pricing and review the math of how to initially price resale restricted housing. The goal is to price the house so that it's not only affordable to the first buyer, but with the help of resale restrictions, it remains affordable to future buyers as well. By the end of this module, you'll be able to explain the concept of affordable pricing to a colleague using key vocabulary, understand the industry standards related to affordable pricing, develop a list of reasonable assumptions to use in your calculations, calculate an initial affordable price, test your affordable price against market and funding realities, and be able to access additional resources that can help you implement these lessons in your work. Let's review a few definitions. Different programs use different terms to describe the same thing, so I want to make sure that you understand what I mean as I talk about affordable pricing. The community investment is the subsidy that a program brings to reduce the cost of housing, or the reduction in price that an inclusionary housing ordinance creates. The purchase price is the price that appears on the settlement statement of a real estate transaction as the contract sales price. It's the price the buyer agrees to pay for the home. The affordable price, or what some call the base price or subsidized price, is what the purchase price seems like to the buyer. It's the money that the buyer actually brings to the table to buy a home, including any down payment and their first mortgage. Traditionally, resale restricted homeownership programs calculated the affordable price by taking the cost of the house, either the market value of an existing home for sale or the cost to develop a new home, and reducing that number by the amount of community investment they were able to bring to the deal. Similarly, inclusionary housing programs often leave it up to the developer to price the homes they are required to build. But when setting an affordable price for your resale restricted homes, you want to start with a price that is truly affordable to your target market, and make sure that this price will stay affordable over time. You do this by backing into a price that works for your target market, and then test your assumptions to see if this home will maintain its affordability for the long term. Given that the price you set will determine the revenue you'll receive for selling your homes, it's important to note that this analysis should be part of your feasibility upfront. That way you'll know before you commit to a project how much community investment you'll need and if that's a viable number for you to secure. Let's do an exercise together to generate and refine an affordable price. There are 6 steps to calculating an affordable price. Identify a set of key assumptions, calculate an initial affordable price, test the affordable price by varying the assumptions, test the affordable price against market realities, test the affordable price against funding realities, and go back to the top and adjust the assumptions as needed. In order to come up with an initial affordable price that will stand the test of time, we've established a set of reasonable assumptions upon which to base our calculations. We're going to make 5 key assumptions and calculate the math for each assumption based on a community we'll call Coffeetown. Coffeetown's located in the Pacific Northwest. With a popular tourism industry and high demand for its premium coffees, Coffeetown has a relatively strong market. Because of that, low to moderate income homebuyers are priced out of the for-sale market and cannot afford to buy a home. We work at Coffeetown CDC and have several homes we'd like to sell to low to moderate income homebuyers. At Coffeetown CDC, we have a 2-bedroom home, and I'm going to assume that we'll sell it to a household of 3. There are 2 common approaches to this question. One is to say that the number of bedrooms equals the household size, and the other is to assume one more person than the number of bedrooms. The actual family who buys this house may or may not fit that household size, but this is a reasonable assumption for the purpose of setting an initial affordable price. If we assume that we're serving a larger household, we're assuming a higher income, and therefore our homes will be more expensive. Conversely, if we use a smaller household size, we're assuming a lower income and therefore lowering our price. In Coffeetown, our funding is limited to buyers earning less than 80% of area median income, and the maximum household income for a household of 3 at 80% of AMI is $47,400. That's the top end of our market. Funders generally dictate the maximum AMI that you're allowed to serve with their funds, so your program will need to ensure that all your buyers earn less than that maximum. But not all of our buyers will make the maximum allowable income. We don't want to price our homes so that they're only affordable to a small group of households at the very top of our income eligibility spectrum. We want to create a window of affordability so that people earning less than the very top will still be able to afford the home. There also needs to be some wiggle room so that our prices remain affordable even if our resale formula doesn't perform the way we want it to, or if interest rates or lending practices change dramatically down the road. There's no firm guideline on how big your marketing window should be, but a good rule of thumb is to price your unit for people at incomes 10 to 20% lower than your maximum AMI. For our scenario, let's assume a 15% marketing window. Since we know that we have a maximum eligible income of 80% of AMI, let's reduce that by 15 percentage points and set our price so that it's affordable to a target market earning 65% of AMI. In Coffeetown, 65% of AMI for a household of 3 is $38,512. In Coffeetown, interest rates are currently at 4%, so let's add a 1% buffer and assume an interest rate of 5% for our calculations. The lower the interest rate, the more a household can afford to borrow with a fixed monthly payment. So we ask, what are interest rates today, and are they likely to go up or down in the medium term? If we're at historic low interest rates and we use today's rates, what will happen at resale when interest rates have gone up? The lower the interest rate we assume when we're pricing this home, the higher risk we're taking in the future. A good rule of thumb, if you're not experiencing an extreme high or low, is to add 1% to the current rate in order to create a buffer. The front-end ratio represents the percentage of the buyer's gross monthly income that goes towards their principal, interest, taxes, and insurance, or PITI. For our scenario, let's assume a front-end ratio of 33%. Most lenders allow borrowers to spend up to 40% of their income on their PITI, although it's generally accepted that an affordable house payment should not exceed a third of monthly gross income. Since our household of 3 at 65% of AMI earns $38,512 a year, their gross monthly income is $3,209. And if 33% of this goes towards housing costs, then the most potential buyers can pay towards their monthly housing cost is $1,060. But that doesn't mean that they have $1,060 each month to put towards their mortgage payment, because we have to deduct other housing-related expenses like taxes, insurance, HOA fees, and program fees. These numbers will be different in each community, so be sure you do your research before making your own assumptions about this. For our scenario, I'm assuming $250 of additional housing-related costs. So if we subtract the $250 that the household has to pay for these other housing costs, they're left with $810 per month for their mortgage, principal, and interest payments. Determining the down payment has two impacts on affordability. It sets the minimum amount of cash that a household must have on hand in order to be able to access homeownership, and it reduces the overall amount that the household needs to finance. For our scenario, let's assume that the buyer's cash only covers closing costs and therefore does not impact our affordable pricing calculations. Some lenders will have their own requirements, so you should ask your lending partners if they have set down payment requirements. Remember, there will also be additional closing cost fees that will require cash in hand. Now we're finally ready to put all of our assumptions together and calculate the initial affordable price. As a reminder, we're assuming a household of 3 with a gross monthly income of $3,209 who spends $1,060 per month, or 33% of their income, on total housing costs. A total of $250 goes to pay taxes, insurance, and other housing costs, which leaves $810 for monthly principal and interest payments. The first mortgage loan is set at an interest rate of 5%, and we assume a down payment equal to closing costs. You can use Excel or another financial calculator to do the math, but an $810 payment at 5% fixed interest for 30 years translates into a mortgage of $150,880. Since we assume no down payment, this is our affordable price, the amount that a household of 3 at 65% of AMI can afford to finance. Now that we have our initial affordable price, we're ready to put it through a series of tests to see if it will work in the real world. We'll start by varying our assumptions so that we can see how they impact affordability in our end price. Let's try 3 variations. First, let's keep everything the same, but increase the assumed interest rate from 5% to 6%. We already know that the higher interest rates limit household purchasing power, so we should expect the affordable price to decrease. An $810 a month payment at 6% for 30 years translates into a mortgage of only $135,101 rather than $150,888, which we got using the 5% rate. So you can see that just by changing our interest rate assumption by 1%, the affordable price fell by about $16,000. Now let's try it a second time, this time keeping the interest rate at 5%, but raising our minimum eligibility income from 65% of AMI to 70% of AMI. At 70% of AMI, the annual household income for a household of 3 is $41,472, and the gross monthly income is $3,456. Multiplying 33% by the higher monthly income of $3,456 equals $1,140 available for housing expenses, and after we deduct the $250 for the other housing-related expenses, we have $890 available for principal and interest, which at 5% translates into a mortgage of $165,791. Finally, let's set the interest rate at 6% and raise the minimum eligibility income from 65% of AMI to 70%. So from our previous calculation at the higher AMI, we'll have $890 available for principal and interest, which at 6% translates into a mortgage of $148,445, just a little lower than the 5% rate for someone earning 65% of AMI. So for this community, I'm going to go with an affordable price of $150,000. It worked for our original set of assumptions. It was between variations 1 and 2, and it's very close to the number we came up with in variation 3. So I think it's a reasonable price and a fairly safe bet. Once you've determined your affordable price, given a set of reasonable assumptions, you need to dig a little deeper to ensure that there is a market need for your product at that affordable price. Compare the affordable price against market prices for a comparable home. If your number is too close to the market pricing, no one will buy your home because they can buy a market rate home and not have to agree to resale restrictions. I like to ask, is this a rational economic choice for someone to make? In Coffeetown, comparable market rate housing is selling for $300,000. So it's easy to compare our $150,000 affordable price to that and feel confident that it would be a rational choice for our target buyer to buy one of our homes. Next, compare how that monthly payment associated with the affordable price compares to market rate rents in the area. If the jump from renting to owning is too steep, you'll likely have trouble selling your units because people can rent for substantially less, which might be the right economic choice. Let's look at how a $1,060 PITI payment compares with market rate rents for a comparable home in Coffeetown. In Coffeetown, market rents are between $750 and $1,200, so when compared to the monthly payment of $1,060, we can feel comfortable guessing that a renter would consider making the transition to homeownership. These comparisons are easy to make in Coffeetown, which has a strong economy. How would our initial assumptions hold up in a weak economy? When we use the same assumptions in a weaker economy, the conclusions are very different. Let's look at Peachtown, located in the southeastern portion of the U.S. Several major employers have moved out and many families have relocated to find jobs. Peachtown is struggling. 65% of AMI for a household of 3 in Peachtown is $26,000 or $2,166 per month, about $12,000 less than a similar household in Coffeetown. Assuming that our target buyer still spends 33% of their monthly income on housing, but $175 on other housing-related costs, they're left with only $540 to go towards their principal and interest payment. Assuming an interest rate of 5% and closing costs equal to the down payment, this translates into an affordable price and mortgage of just over $100,000. Market rate housing in this town is depressed, and there have been a lot of foreclosures. A typical house sells for $75,000, but often needs a lot of work, so I'm assuming about $30,000 of rehab for a total cost of $105,000. But given the depressed market, the house is likely to only appraise at $85,000 post-rehab. We just did the math to see that someone earning 65% of AMI can afford a $100,000 mortgage. This means that people earning 65% of AMI have a shot at stretching to afford a renovated market rate house, or they can buy a market rate house in its current condition for $75,000 and take their time to fix it up on their own. So in this case, we're not likely to find buyers willing to pay $100,000 and agree to resale restrictions when they can essentially afford market rate housing. At this point, we need to pause and ask whether the project still makes sense. It may be that we're trying to revitalize this part of town, so we can use some community investment to lower our cost to a price that would be more competitive. There is no official industry standard for how far below market prices resale restricted housing needs to be, and of course it depends on other factors like condition, amenities, location, etc. But a good rule of thumb is at least 20% below market. In Peachtown, a 20% discount from the market value of $85,000 would be an affordable price of $68,000. This might now be a rational economic choice for the buyer, but we also need to reevaluate our new price and determine what household income is needed to afford that home. It may be that the income associated with that price is too low to reasonably be able to afford a mortgage and still be able to pay for the other costs associated with owning a home, such as utilities, maintenance, and repair. If that's the case, it may be that this project is not viable in Peachtown given the current market and community investment available. However, if you have other programmatic goals to revitalize the neighborhood, you may be able to justify increasing the community investment to a point where the numbers do make sense for your new lower-income target buyer. But you're now moving forward with a better understanding of the resources necessary to be successful and the associated risks. Once you've calculated a price that is affordable to the target market and determined that it would be a rational economic choice for someone to buy the homes, you have to figure out how to fill the gap between your affordable price and the market value or your development costs of the home. For example, in Peachtown, it will cost $105,000 to buy and rehabilitate the house. And if we determine that the affordable price that works is $68,000, we need $37,000 of community investment to make this deal work. In this scenario, we've already determined that increasing the price is not a viable option. So if we can't find community investment, our project does not move forward. Back in Coffeetown, we know that it costs $250,000 to build a home, and our affordable price is $150,000, so there's a $100,000 gap. That's where the community investment comes in. As long as we can secure a community investment of $100,000, our project is whole. But let's say we can only secure a community investment of $75,000. Now we have a $25,000 hole that we need to fill. We can scour for other funding sources for additional community investment, but that might not be available. We may need to revisit our assumptions and see if we have any wiggle room. Remember that affordable pricing is an art, not a science. That analysis may lead us to consider using $175,000 as our initial affordable price, understanding that we're taking a higher risk in narrowing our target market, assuming a larger household size, lowering assumed interest rates, or all of the above. But now let's say that we only have $50,000 of community investment, and we would have to sell the house for $200,000 in order to be made whole. In this case, we have to revisit our assumptions and calculations and see what percent of AMI would be affordable to, and at what interest rate, and reanalyze the numbers. If you're working with a municipality crafting an inclusionary housing ordinance rather than looking at available funding, you have to look at the market realities and decide if there's adequate economic incentive for developers to build these houses with your inclusionary requirements and be able to sell the market rate units at a price that makes the entire project profitable. If the answer is no, then you may need to consider increasing your affordable price and therefore your target market. Now back in Coffeetown, we have to decide, is $200,000 an affordable price? If we go back to the top and repeat our calculations, we find that a buyer now has to earn $48,000 to afford a $200,000 house. And if you remember our cap, 80% of AMI, is $47,400, we can't actually price our homes at $200,000. At this point, we have to go looking for more community investment or find ways to reduce the cost before moving forward. It's important to remember that this is all part of the feasibility analysis and should be done before you fully invest in a project. Now that you've done this and you've found out that you need more community investment to go forward, you're glad you did this before you purchased the land and got started. Now you can either look for more community investment, find ways to cut costs, or decide not to move forward with this specific project. This completes the process for determining the initial price for resale restricted housing. In the next module, I'll walk you through the fixed rate resale formula and how it works. Thanks for joining me.